The New England Business Group presents It's All About Business. Our presentation today is Potential Funding Sources for Your Business Idea, Part 1. Welcome to the sixth presentation, Funding Sources Part 1, in the New England Business Group Pre-Startup Series. This session will present potential funding sources for your business idea, while the entire 7-presentation series will help you evaluate your business opportunities so that you can reach a go, no-go decision. I am Larry Gable, President and CEO of the New England Business Group, and I will be your presenter today. The New England Business Group has crafted a pre-startup process to help the entrepreneur organize thoughts and prioritize activities in order to optimize idea development and research processes leading to a go, no-go decision based on market research. The result is an informed decision process that is geared to the realities of the marketplace. The net effect for the entrepreneur is to have acquired an enhanced information set upon which to build a business plan. The work and effort invested in the business research and analysis is not wasted, but rather immediately useful in the development of a business plan. The Funding Sources module is the sixth of 7 modules. It is designed to help the entrepreneur focus on the funding of the business idea being studied. It introduces basic funding concepts and sources and rationalizes the business funding sources with its potential returns on growth prospects. The module concludes with a specific discussion of various funding sources and a real-world example of a venture capital-funded business. We want to spend a bit of time today discussing one of the most prevalent causes of business failure, and that is insufficient capital. A common fatal mistake for many failed businesses is having insufficient operating funds. Business owners underestimate how much money is needed, and they are forced to close before they've even had a fair chance to succeed. They also may have unrealistic expectations of incoming revenue from sales. It is imperative to ascertain how much money your business will require, not only the cost of starting, but the cost of staying in business. It is important to take into consideration that many businesses take a year or two to get going. This means that you will need enough funds to cover all the costs until sales can eventually pay those costs. Often the hardest part of starting a business is raising the money to get going. The entrepreneur might have a great idea and a clear idea of how to turn it into a successful business. However, if sufficient finance can't be raised, it is unlikely that that business will get off the ground. Raising finance for startups requires careful planning. The entrepreneur needs to decide how much is required, when and how long the finance is needed for, what security, if any, can be provided, whether the entrepreneur is prepared to give up control, that is, ownership of the startup, in return for investment. So the finance needs of a startup should take into account these key areas. Startup costs, that's the costs incurred before the business becomes a trade. Starting investment in capacity, that is the fixed assets that the business needs before it can begin to trade. And working capital, and that is the capital that supports the stocks needed for business with, for instance, raw materials and pieces and parts, plus an allowance for amounts that will be owed by customers once sales begin. And then growth and development. That's the extra investment that is needed to increase capacity. One way of categorizing the sources of finance for a startup is to divide them into sources which are from within the business, that's internal, and from outside providers, that's external. Most new businesses don't start with a bank loan. A recent survey reported that bank loans comprise less than 15% of startup capital. This does not mean you should not look for a bank loan, just that it is not the only source to consider. From the startup perspective, investments break down into 2 forms, debt and equity. You take on debt when you borrow money from a lender and pay interest on that investment. You are required to repay money with interest over time, or you can take on an equity investment in which you sell a portion of your company to an investor in return for cash or something else of value. Also keep in mind that most lenders won't finance 100% of your business. So your first source of capital will probably be a loan from yourself. there are definite advantages for you there. 100% control and ownership. You own the whole company, control the whole show, and stand to reap the gains should your venture become valuable. But there's a huge potential downside as well. Even the best researched and well-run startups involve risk, and you are putting your assets online. A bank is a place that will lend you money if you can prove you don't need it. That's a quote from Bob Hope. Right, let's realize that financing is hard work and it takes considerable effort and creativity. You need to choose the right sources, and that's a decision that will influence your company for its lifetime. The money is out there. The key is knowing where to look. So you need to do extensive research and comparisons to ensure a successful search. The web is a powerful tool to aid you in your quest for capital. Ensure that your business plan has been thoroughly prepared and that you are capable of answering all the relevant questions a financier may ask. So you've got things at your fingertips, but you still need to have a very thorough business plan, and you should not underestimate the importance of making sure that the chemistry between you and your funding sources is a good one. So let's look at the two types of financing. Basically, funds originate in two places. Your personal assets, that's the internal part, from an outside entity, that's the external part. So if you possess sufficient assets to fund your business, you are indeed fortunate. If you are like the vast majority of us, we must look for other sources to garner the funding to start or grow a business. So those external sources, which we're talking about here, come in two types. Equity financing, in which you're required to give up a portion of your ownership stake for the required funds, and debt financing, which requires the repayment of principal plus some amount of interest for the use of the money. We have used the word capital, so let me define the word in the financial sense, the three types of capital. Capital is any form of wealth employed to produce more wealth for a firm. And we consider three types of capital when discussing the requirements of a business. The first is fixed capital, which is used to purchase the permanent or fixed assets of the business, buildings, land, equipment, similar things. Second is working capital, which is used to support the company's normal short-term operations, where you buy inventory, pay bills, pay wages, salaries, etc. And the third type is growth capital, which is used to help the small business expand or change its primary direction. Some sources of capital. As you can see, there are a number of sources that may be tapped for funds to start and grow a business. This money can come from many different sources, and we want to help you identify which sources are most appropriate for your business. Remember that most new businesses don't start with a bank loan. A survey reported that the bank loans comprise less than 15% of startup capital. This number goes up to maybe 40% with existing companies with less than 20 employees. This does not mean that you should not look for a bank loan, but only that it's not the only source to consider. So let's look at some of the sources. There's self-funding, there's friends and family, retained earnings, grants or other government programs, which are difficult to get for startups. There's peer-to-peer or micro-investors, and crowdfunding, which has become much more popular in the last few years. Then there's conventional finance, that's banks and finance companies, and the Small Business Administration, which does not loan directly to investors, but rather loans through its agencies on a commercial basis and built to SBA requirements. And what that means is that you'll actually get the money from a lending institution, but its repayment is guaranteed by the Small Business Administration. Then there are private investors. These are angels and private equity. Next then is the EB-5 Foreign Investor Program. The EB-5 basically says that if a qualified foreign investor invests $1 million in a U.S. Company, they can get a visa. Then there's venture capital, which are professional capital investors looking for high value investments. Then there's strategic partnerships with larger corporations perhaps, or other companies similar to yours. And last is the initial public offering. That's where you will offer shares on a public forum for your company. But for startups, it's often easier to get the money from individuals or groups of individuals, while companies which have a track record of success are more apt to find an audience with the institutional lenders. Here are some options for funding your small business. Remember, it is unlikely that the money will come from one source, keeping in mind that most lenders won't finance 100% of your business. So you'll probably need to seek capital from several of these sources. So let's look at the capital fit. If we go from left to right, you will see that we move from research to seed to startup to early growth. And above in the boxes, you will see the sources of capital that are most likely and frequently fit the pre-revenue or revenue status or stage of the business. So the early basically are founders' savings, friends and family, and foundation grants from the government and things like that, followed then by angels or EB-5, and followed when the company is formed and actually operating in a growth environment. You have the venture capital and equity that will probably lead to an IPO or a sale to a strategic investor. So basic advice. Personal sources, occasionally required, but it's generally the easiest and quickest, and the personnel take a stake, which in actuality may be required by some lenders. And remember, raising money is hard work. So it's a distraction from running your business, and be prepared for the funding gap. And a funding gap is developed between the friends and family investments, typically from a $0 to $250,000 range, and amounts that most venture capital funds prefer to invest between $1 million and $2 million. So there is a considerable gap there that you need to be aware of. This funding gap may be accentuated by the fact that some successful capital funds have been drawn to raise ever larger funds, requiring them to search for correspondingly larger investment opportunities. So this gap is often filled by seed funding via angel investors, as well as equity investment companies who specialize in investments in startup companies in the range from $250,000 to $1 million. The common theme in this capital chase is a well-prepared and thoroughly thought out business plan. So remember that raising money is hard work, and it can be complicated, and it all starts with the investment grade business plan. Do get experienced advice if you haven't written business plans before, and some free advice is available via SCORE or the SBDCs. And I also recommend that you create a business advisory board, which is a group of experienced individuals that will help you through the initial setups and then the running and growth of your business. So let's look at some more basic advice. It's definitely more art than science, that is raising money. And in fact, it may be your first big sale. There are generally accepted standards, but they will vary somewhat from firm to firm, so make sure that you understand the standards of the firm you're dealing with and what their likes and dislikes are. And it's likely that you will need access to several sources of capital to meet all your needs. And remember, everything is negotiable, but negotiable does not always work to your advantage. That is, whoever has the money makes the rules. So let's look at some personal sources of investment capital. Every business guru on the planet will tell you that you never mix your personal assets with your business, that you should always keep your personal income and expenses separate from your business. This is for tax and liability reasons generally. In the cases where you must use personal assets, treat those funds as a loan to your business. This includes drawing up and signing loan documents. It could be a single-page agreement and notarized, as well as a real, relevant interest rate. Then, to show others that this is a transaction that is ongoing legal business matter, make sure that you pay yourself from your business regular payments. No skipping, even if it hurts. You may have to treat your business just like a third party, say a bank, would, and create a solid paper trail that keeps the line between your person and your business separate. So we run down a quick review. Most are pretty obvious: 401ks, savings, mortgages or second mortgages, credit cards, which I recommend you try to stay away from, asset sales, investment sales, opening lines of credit that can perhaps help as you move through the startup stages. And then there's personal loans, which will include business loans if that's available. And then there's life insurance. That is cash value that you could take from life insurance. And then there's trade downs, which I probably need to explain. Basically, that means lowering your living run rate. I had a friend who went from a 1,800-foot apartment to an 800-foot apartment and moved from leasing a Mercedes to leasing a Honda. But over a course of 2 or 3 years, he saved enough money to really give his business a good start. Now there's friends and family funding. Basically, you're offering an opportunity to your family and friends to receive a much better return on their invested money than they're currently getting from their bank accounts, certificates of deposit, and saving accounts. With many of these savings depositories only earning 2 or 3% per year, your friends and family aren't even keeping pace with inflation in some years. Just be sure that they understand the risks. However, more than ever before, your access to friends and family funding and your personal resources are going to be critical to your ability to successfully launch your business and raise outside capital later on. So let's talk about briefly what a bridge loan is, and we'll come back to friends and family funding. A bridge loan is interim financing for an individual or business until permanent financing or the next stage financing is obtained. Money from new financing is generally used to pay back the bridge loan as well as support other capitalization needs. Bridge loans are typically more expensive than conventional financing to compensate for additional risk. Bridge loans typically have a higher interest rate, points, or other costs that are amortized over a shorter period, and various other fees and sweeteners such as equity participation by the lender in some loans. The lender also may require collateralization and a lower loan-to-value ratio. On the other hand, they are typically arranged quickly with relatively little documentation. So the friends and family funding guidelines include: consider the impact of the investment on everyone involved, keep all arrangements strictly business, settle all the details up front, create a written contract, and this is a must-do. You need to have a written contract that takes everybody's interests into account, and then you treat the money as bridge financing, as I just discussed. And lastly, you have to develop a repayment schedule that suits both parties. Then there is retained earnings. Retained earnings is the cash that is generated by the business when it trades profitably, and it can be another important source of finance for any business, large or small. Note that retained earnings can generate cash the moment selling has begun. For example, a startup sells its first batch of stock for $5,000 cash. which it bought for $2,000. This means that your retained profits are $3,000, which can be used to finance further expansion or to pay other costs and expenses. Note that for a business-to-business business, you may want to consider factoring your receivables, which is an asset, to smooth or accelerate cash flow. Let's look at some non-traditional sources. Grants, first of all. Grants are available most frequently to nonprofit companies, although some grants exist for for-profit companies. What is almost impossible to come by is a grant for a business startup. Most grants are made available for the development of a product or service that will benefit the public or will generate a product or service that the government needs. Some state and local governments have grant money or act as clearinghouses for federal funds. Contact your state or local Office of Economic Development to find out about these possibilities. Then there's peer-to-peer lending. Peer-to-peer lending has been around for a while, and many small business owners from all over the globe are using it to grow and prosper. Having no chance to get cheap loans from banks, entrepreneurs are addressing the internet with this problem, so you can now borrow money online at low interest rates for both personal and business needs. Peer-to-peer sites connect the individual borrowers with the lenders and take a fee for the service. Lending Club, for instance, will take 2 to 5% cut for providing the services of screening borrowers and issuing loans. So here are a very brief list of some popular sites. There's Kiva.org, which was launched in 2005, and they offer microloans basically to poorer starters. Then there's Prosper.com, which is a place for people to get personal loans and lend to others in the form of an online auction where users bid on loans and yield percentage they are willing to receive. And this is eligible for U.S. residents only, but the total number of users has flown by 1 million in the very recent past. So loans from 1 to 25,000 our average lending period for 3 years are available via Prosper.com. Then there's LendingClub.com, which is more like a traditional bank. While registering as a borrower, you fill a simple loan application. The website's experts assess your creditworthiness and collect your personal information, which is not disclosed to others. And after that, your loan is listed for about 2 weeks, which, according to Lending Club, usually is enough to get your funding. The loans range from $1,000 to $25,000. Word of caution is that peer-to-peer lending also attracts borrowers who, because of their past credit status or lack thereof, are unqualified for traditional bank loans. The unfortunate situation of these borrowers is, however, well known for the people issuing the loans, and the results are a high interest rate that verges on predatory lending and some loan sharking. So be very aware of what the requirements are for a peer-to-peer lending institution. Some more non-traditional sources. And the first is crowdfunding. And crowdfunding describes a collective cooperation, attention, and trust by people who network and pool their money and other resources together, usually via the internet, to support efforts initiated by other people or organizations. Crowdfunding sites usually pool a large number of small loans or donations. These sites vary, but one of the most common known is Kickstarter, which posts details of creative projects that range from producing a movie to opening a vegan restaurant. The backers don't get their money back or interest. Instead, they receive a reward, such as a DVD of the movie produced. And then there are customers, another non-traditional source, and that is customers can advance payments, assuming the terms aren't too onerous, and give you the cash that you need at a relatively low cost to keep your business growing. Advances also demonstrate a level of commitment by the customer to your operation. Many very successful businesses have been funded by their customers. This strategy allows them to grow faster with limited resources and to operate with relative impunity with respect to their investors. Then the next is vendors. Again, a very non-traditional source. But realizing that Dick Schultz built Best Buy with financing from large consumer electronics firms, in other words, his suppliers. This way, your financiers do not control your growth, you do. Just be sure not to enslave yourself to a small handful of powerful suppliers in the process. Vendors may also finance your customers so that they can purchase your inventory. Now let's take a look at conventional finance. Conventional finance from banks and other lending institutions is oriented for the growth of an existing business. They intentionally avoid startups and restaurants. The general rule of thumb is in operation for at least 24 months and profitable with market potential. The business plan and market potential are important as always. And business lines of credit, term loans, mortgages are all generally available. There are two basic types of loans you might want to consider. First is a business loan, where most small business loans are secured with company or personal assets. Lenders will usually ask for personal guarantees as well as collateral from anyone who owns more than 20% of the company. The bank's reason for requiring collateral is, in part, to gauge whether you think your company is worth the risk you are asking them to take. Business loans have more strict requirements than consumer loans. For example, if your business is in tough financial times, your bank may ask you to immediately pay off the full amount of the loan, something that is unlikely to happen with a consumer loan. Now, consumer loans are basically a way to fund many small businesses, and they're based on personal assets. Consumer loans, home equity loans, second mortgages, mortgage refinancing, and personal loans are easier to obtain than business loans if you have a good credit history. Some banks don't mind if you take a consumer loan and use these funds for business purposes. Others will refuse to lend to you if you tell them that you need the money for business purposes. Keep in mind that if you tell a banker a loan is for personal use and you use it for business, that lie constitutes an act of fraud. Consumer loans require less paperwork than commercial loans, and the approval process is much quicker. It is also unlikely that you would be asked to repay the loan back in full if your business falls on hard times, something that can and does happen with a business loan. Finance companies. Finance companies are the companies that make many car loans. They take on higher risk commercial loans than banks and can handle business loans. If your small business will continually need your loan ceiling increased, a finance company may be the best bet. Some of the situations that may precipitate your need to go to a finance company are your company is high growth and will continually need its loan ceilings raised, your credit history is spotty, or your company has a high debt-to-worth ratio with strong cash flow. Greater risk usually brings higher cost, and finance companies are no exception. Rates and fees will be higher than banks. Now let's look at the Small Business Administration. The Small Business Administration, the SBA, does not make direct loans to small businesses. Rather, the SBA sets the guidelines for loans, which are then made by its partners, that is, lenders and community development organizations. The SBA guarantees that these loans will be repaid, thus eliminating some of the risk to the lending partners. So when a business applies for an SBA loan, it is actually applying for a commercial loan structured according to SBA requirements with an SBA guarantee. SBA guarantee loans may not be made to a small business if the borrower has access to other financing on reasonable terms. Funds guaranteed or provided by the SBA may be used to build or start a business, not as a means of paying off creditors, to cash out investors, or for investment in real estate, among some other restrictions. Qualifications for an SBA loan do change over time and with the nature of your business, but general guidelines for qualifying are: your business must meet some size limits set by the SBA. The business must be a for-profit entity. The business cannot dominate in its field, and the business must be independently owned and operated. So when you apply for an SBA-backed loan at your local bank or credit union, you're asking the SBA to provide a guarantee that you will repay the loan as promised. The SBA sponsors a variety of loan and grant programs that are available to small business startups. All right, it's time for questions and answers. As we bring this session to a close, I have a question from our studio audience. And the question is, how much do small businesses rely upon credit cards? Well, financial sources tell us that most small business financing comes from business and personal loans, with some 6% from outside equity, that is, angels and VCs. Startups depend about equally on the owner's cash injections and bank credit, and the most common sources of startup dollars are the owner's and relative savings. Given that, small businesses do use credit cards extensively, but they only account for a small portion of total business capital. Roughly 7% of all startup capital is derived from credit card transactions. A recent report by the National Small Business Association shows that credit cards, as the third most popular financing choice after retained earnings and bank loans. We have completed part 1 of step 6 of the 7-step process. These are the main topics, or this is the main topic remaining. Note that the series can be used for one or multiple ideas, so please be with us for our next session, Funding Sources Part 2, where we will answer the question, should venture capital be a consideration in your search for funds?